The following program is being brought to you on the Voice America Business Channel. For more information about our network and to check our additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the following program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and management.
Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Tim Mccarthy. He was the former president at Fidelity, also president and chief operating officer at Charles Schwab, and he's just authored a new book called The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. Welcome to the show, Tim.
Well, thank you. I enjoy talking with you.
Let's start with your background. I mentioned it a little bit, but why don't you go through each of these individually? You started before you got to Schwab and Fidelity in the Far East, and tell us a little bit about your experience there.
Well, way back when I started working there first in the late 70s, early 80s, when then most of Asia was deep in the emerging market side, where they needed help in basic training and manufacturing, and it's just such a contrast to what particularly East Asia is the last decade. And then when the markets turned around in the U.S., I went to Merrill Lynch and spent most of the 80s at Merrill Lynch, but in 87 then moved up to Fidelity.
Doing what? I mean, what was your role at Fidelity?
Well, at Fidelity, I ended up being president of two different companies, one being National Financial Institutional Services, which is this is basically helping banks and brokers get into both mutual funds and then more discount brokerage, and then took over the Fidelity Investment Advisor Group, which grew the fee-only investment advisor business. And so that was a great experience because I got a chance both at Fidelity and then later at Schwab to get to really know particularly the fee-only investment advisor business, how they operate those advisors, and how they differ from full-service brokers.
And then you moved to Schwab, and what was your role at Schwab?
Well, in between Schwab and Fidelity, it's an important element because I was picked to be chief executive of Jardine Fleming Unit Trust, which was the big mutual fund company down in Southeast Asia, Hong Kong, and Taiwan, and the like. So that gave me a lot of experience of what was going on in the rest of the world that I wouldn't have otherwise gotten working for an American company. Then I moved to Schwab, and the main accomplishments there were really getting in and promoting OneSource, which was the mutual fund supermarket, really getting in and getting people comfortable with no-load funds and with fee-only advisors selling no-load funds, and then also was part of the team that introduced Internet trading, brought the web in effect to everybody for trading, and was president of Charles Schwab and Company until late 1998.
And then what happened after Schwab?
Well, I put together a group of private equity investors, and first bought, in the middle of the IMF crisis in Korea, one of the largest investment banks in the country that was in deep trouble, and brought in a lot of technology and marketing techniques and training that we'd done in the U.S. and localized it for Korea. And we built that company up to be worth about $1.2 billion, and when the investors had made 600% of their money in 3 years, they said to me, "Tim, that's our number, so can you sell it for us?" So I sold that off to Shinhan Bank, and then basically did the same thing in Japan, where Nikko had a fund company that was troubled and put together an investor group and took that over and built that from about $50 billion in assets to $160 billion in assets. And we became basically the largest independent asset manager in Asia, one of the largest in China and Malaysia, Singapore, and the like. So built it throughout, even India and Australia.
So you've had a lot of international experience here. It must be amazing, just before we get into the book a little bit, kind of the maturity of Asia from where you first started there in the 70s to where it is now. What is the future of Asia, since you have so much experience there?
Well, there's like anything else, I think one of the things that we have to do from the West is not look at Asia as a single region. It's not like looking at the United States. You've got very developed countries that are starting to look a little bit like the U.S. In Western Europe, in that a South Korea, Japan obviously, but a South Korea and Taiwan, Hong Kong, Singapore, they're starting to get old and pretty mature, pretty sophisticated, and will track more similar to the developed countries. China is sort of in the middle. It's an aging population due to the one-child policy, but they still have a lot of growth left in their economy. And then you go all the way to the other spectrum of very exciting, high-growth, younger countries that are finally emerged, and it's taken a long time. And I'd put Philippines and Indonesia into that category. So you really, as I often say, Asia is not a region; it's really multi-local.
So do you think it's an area that a lot of investors, U.S. investors, could successfully invest in, or is it too volatile?
Well, I think the key thing, and it's really a main point in the book, which is that what international investing does is it gives you more diversity. And people don't realize if they only invest in the U.S. or only in the developed countries, they actually are more narrow, more concentrated than they really should be. They're making too big of a bet that older demographic countries do well. So when you invest in the younger countries, albeit they can be volatile, but so can the developed countries, but what you get is diversity, and that's so important when you're building a long-term portfolio. So most people don't talk about broad-based international investing as a way to decrease risk, but over your lifetime, it's actually a major factor in helping ameliorate risk as well as get a little broader return.
The title of your book is To Become a Safe Investor. Why is safety so important? I mean, some people would say if you're being super safe today, you're earning almost no return with CDs and money market funds and cash basically earning nothing. And you've got to take risk in order to have your money grow, to have a decent retirement and be able to live a long time. That safety is not as important today and growth is more important.
Well, it's interesting. All along, back when we had an interest rate of 5-6%, people could say, hey, if I'm a safe investor, all I got to do is just put my money in a CD, and it'll get me the growth, probably even more than inflation, and I'll be fine. Those days are gone. This century, we've seen pretty much for most of the start of this century, and it doesn't look like it's ending anytime soon, is inflation, even at a low level, is still going to be more than what you're getting in the bank. So now all of a sudden people say it's not so safe to only be in the, quote, no volatile, safe assets because I'm not getting the growth I need, and I'm living a lot longer than I expected to. So is that really the safe mode? And yet when people turn to all of the assets that do have volatility, immediately then the whole focus becomes on performance. And people are saying, yeah, look, I don't know if I necessarily need to always have the absolute best performing, product or asset class or stock, as much as I'm still worried about safety. So how do I, and this is the central question people ask and don't get good answers for, how do I grow my money more than savings so I get it above inflation, but at not the risk of trading that comes from trying to guess or make a bet on a particular stock or market and the like? And the answer is pretty simple, so I focused the answer on, in effect, a different set of objectives, which is, how do you still grow safely? Because, being the money and having the money just in the bank is not safe anymore.
It's not only not safe, but you're losing purchasing power because while your money's sitting there earning nothing, your costs of food and energy and healthcare and taxes are going up. So kind of silently, you're actually losing purchasing power. Is the point I like to make.
You look over the next decade, if you just had it in the bank, you're probably going to be somewhere between 10 and 20% loss of purchasing power through there. So, but then you say, okay, now how do I then go into the broad assets safely? And that's what the whole book is about.
So much of what you talk about in the book is about psychology, and you've seen the ups and downs, particularly the dramatic ups and downs in the emerging markets in Asia and the meltdown in Korea and then the soaring amount after that. How can the average investor deal with the kind of dramatic ups and downs and not get shaken into selling when there's fear and piling in when there's greed, as is typical?
Well, it starts first with time, understanding time. And unfortunately, we're all geared around being very short-term and how we evaluate things. And sure, oftentimes you'll hear on TV, on the shows, oh, we have to be long-term investors. They say that for 30 seconds, and then they spend the next 20 minutes on the show talking about getting in and out of markets over the short term. So it's better to look at your portfolio the way you'd look at an aging Scotch or Bordeaux wine or an almond tree, where you're thinking in longer cycles. Because what you see when you think that way, and indeed your retirement plan is that way. Even if you're 60, given probability says at least you or your spouse are going to glow by 90, that means you need 30 more years of growth. Well, then when you start thinking about that's the reality of your life plan, and then at the same time, that's also the reality of how you decrease risk in your portfolio by understanding that these different asset classes go through cycles that are often a half a decade or a decade long. So long as you're in these cycles long enough and don't panic, that's where safety comes from, is understanding how to manage that time. That's where I came up with the concept of trickling, which is so important, trickle investing, I call it. A lot of times they'll call it average price or average cost investing. The problem is dollar cost averaging thing. Most people don't understand what you're talking about, where they can't understand, hey, if you trickle in a little bit into the markets each year from, let's say, the time you're 45 to 65, and then make sure to only trickle out a little bit each year for the rest of your life, what that does is just take away the volatility of the portfolio. That's key to decreasing risk. And the second thing is diversification. And again, that's something that's not often focused in on. People say, oh, you diversify across the different major asset classes. But then they switch around too much inside of them, or they don't look at things like what I call SPOF, single points of failure, getting inadvertent over-concentration in a portfolio. So when you think of safety, then you think, have I really analyzed the whole portfolio to get rid of inadvertent single points of failure outcomes there? So,
would an example of that be you have a stock plan at your employer, and you're getting stock all the time, and your employer and your stock is your biggest holding? Is that would be an example of that under diversification?
That would be a perfect example of it. But what often then becomes the inadvertent ones is, let's say you're in high tech hardware maybe, and so then you've got way overexposure in that through your company. But then when you look at your funds and makeups, you end up often inadvertently doubling up your bet there because you're not doing enough diversification. Another big diversification that people often mix is geography. They'll do most of their investing, their real estate portfolio and everything, in a particular area where they live. They may end up owning a lot of companies in that area, owning municipal bonds or state debt in that area, and they don't realize that we all know what can happen with the environment and with climate, with earthquakes and the like. And so making sure you even get good diversification, a diversity of geography. There's a lot of things you have to go through for a safe investor to make sure you're really properly diversified.
Okay, we're going to get into this in more detail, and we're going to take a break now. My name is Jordan Goodman of The Money Answer Show. My guest this hour is Tim Mccarthy. He was the former president at Fidelity Investment Group and also at Charles Schwab. His new book is called The Safe Investor: How to Make Your Money Grow in a Volatile Global Economy. We'll be back after this.
We're always talking business. Talk to an expert. Call now toll free 866-472-5790. That's 866-472-5790. Voice America Business Network.
If you want to know about investing in emerging and frontier markets, or if you have experience in this field but still need to know more, tune in to Emerging and Frontier Markets Investing with Gavin Graham. Gavin explores news, current trends, and insights about both categories of investing. His guest experts, along with his own knowledge, will help you stay above the line when it comes to growth potential, whether in funds or equities. He will look at what to invest in and avoid. Tune in to Emerging and Frontier Markets Investing with Gavin Graham every Wednesday at 9 a.m. Eastern Time, 6 a.m. Pacific Time on the Voice America Business Channel. Listen for exclusive clips from Oprah's upcoming Super Soul Sunday series on Authentic Living with Andrea Matthews every Wednesday at 1 p.m. Pacific Time, 4 p.m. Eastern on the Voice America 7th Wave channel. Then be sure to watch Oprah's Super Soul Sunday on OWN Network TV at 11 a.m., 10 Central every Sunday.
Houston Real Estate Radio with Shannon Register. Tuesdays at 10 Eastern, 1 Pacific on Voice America's Variety Channel.
As we have transitioned into a healthier housing market, supply has not been able to keep up with demand. Appraisals have struggled to keep up with rising prices, and lenders have overcorrected their loose lending practices. We track all this and more so you don't have to.
HoustonRealEstateRadio.com.
We're always talking business. Talk to an expert. Call now, toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Tim Mccarthy, former president of Fidelity Investment Group and chief operating officer at Charles Schwab. His latest book is called The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. Welcome back to the show, Tim.
Thank you.
And tell people about a website where they can find out more about the book and maybe more about you.
Well, if you simply go to timmccarthy.com, that gives a lot of background to the book. Also, rather than do an addendum in the book, we thought it was better to leave it electronic. So supporting documentation details and helping in finding advisor and the like is also on the website.
Very good. Now, at the beginning of the book, you tell some stories from your personal life that kind of inform the way you are as an investor. So let's just briefly go through some of those. The first one talks about the day you became an adult. So just tell us what happened there and how that affected your attitude towards investing.
Well, when I just turned 18, my father was killed in a car crash. And my mother, like, quite frankly, a lot of women, even still today, really didn't pay any attention to the finances side. But then all of a sudden she had to. I was supporting myself. I was running a karate studio at the time, so I could support myself, but my mother still didn't have a job herself and had my 13-year-old brother to take care of. So, like so many people, she went into an office, security's office, and said, I want safety. Give me whatever safety. And at that time, 1969, the standard safe thing to do was to put them into a whole portfolio of long-term bonds, and they were all fixed interest bonds. That was safe. Still is often looked at as safe. Well, in the late 70s, many will remember, the prime rate, I think, got up to 20. The bond portfolio, if liquidated, she'd lost almost half her money if she liquidated, and she panicked and sold, and then just put it all into money funds and the bank. So then when the markets rebounded, she didn't get any of that rebound, and it affected her life. And in fact, at that age is when I decided, watching this through my early 20s, that, there's got to be a better way to do this. And I've spent a lot of my life saying, how do people be a safe investor? How do you solve for that? Because there's got to be a better answer than what has happened to so many people. So that's what I got out of my mom's experience.
Okay, and then the next chapter is about diagnoses for your doctor, and tell us what happened there.
Well, what I noticed is a lot of people, they'll say, I got to be diversified and all that, and so they think they're diversified. And in this case, this was a standard phenomenon, at the turn of the century here, where people would say, okay, well, what I'm going to do is I'll have my own stock portfolio, but that'll only be a small part of my money, let's say a fifth of my money. Then I'll buy an index, which is nicely broadly diversified, and then I'll buy 3 of the Morningstar, top star funds. And then I'm nice and diversified. What they didn't realize is, if you looked at all the components, in other words, what in this case a lot of people did out in California is they invested more in the high tech side and the internet stocks. And then if you look at an index is really just another management strategy. Well, the way that's weighted is to be over-focused in guess what, momentum growth blue chip stocks. That's where the weighting is by definition. Well, at that time it was mostly stocks that were the big, sexy high-tech stocks. And then if you looked at the individual funds that had the most stars, guess what? They were also in the same category. So, even though the Dow for the year when it crashed in sort of 01 in that period then, were maybe only down 15-20%, that quote doctor who thought he was diversified really was down 40%, close to half even at times.
Because he had so much in technology, he didn't even realize he had technology.
Yeah, he didn't realize he was 5 up on his bet. And this happens a lot. It can happen in over concentration in commodities or, as I said before, geography and the like. So you do have to, if you're going to spend more time trying to pick the best fund versus trying to make sure you're properly diversified, you'll do better over a 30, 40-year period with your retirement plan and making sure you just got good diversification.
So in the diversification realm, you talk about dieting and investing. What are the ingredients, I guess you might say, that are common in dieting and investing as far as getting a diversified portfolio?
Well, it is interesting that those in the financial services industry are used to talking a lot about numbers and looking at graphs and looking at the math and everything. An awful lot of people just can't identify with it, and their eyes gloss over, and they're just not interested in it. What I found interesting as an analogy, as a way to explain investing, is how it connects to food, because let's face it, everybody loves to eat, and knows an awful lot of people know an awful lot about diet and the like. Well, what we've discovered about diet is it is actually amazingly similar to having a proper investment portfolio. We now know that good broad diversity in a diet is what makes you healthy. You don't want to focus only in on the bad foods, but likewise, if you have too narrow of just some of the good foods, you do miss a lot of trace elements and the like that's needed in your system. So diversity is good of a diet. And it's the same thing with an investment portfolio. Having even small dashes of a variety of commodity exposure in your portfolio is good, but not too much. I mean, if the whole thing is only 3 or 4%, 5%, that's not a lot if it goes up, if it's volatile. But by the same token, in some down markets, that can really ameliorate your risk there. So that's where food and putting together your diet and putting together your portfolio are amazingly similar.
Is it possible to be over-diversified? Some people have such a large portfolio with so many holdings that they can be over-diversified, it seems to me.
Well, there was phrases like diversification.
Yes, Peter Lynch talking about that, right?
Yeah, except for when you get into it, it actually isn't bad to be overly broadly diversified, because at the end of the day, that means that you're making sure to be exposed to all kinds of different markets and asset classes, even in their bad times. I mean, take gold, for instance. If you had zero gold for years and years, that made a lot of sense. And then for decades even, and guys got fired because they had gold, advisors got fired off them because they had gold, even a small amount in a portfolio. And then in a matter of 2 quarters or so in 2008, that turned out to be a terrific investment. So, even having small doses, broad-based, actually can make a lot of sense. Here's the issue. Once you say, oh, well, I want to be a lot less diversified, then what you're really doing is making a bet. And we all know how terrible, on average, even the professionals are at making those bets. So it's a little bit like what Churchill said about democracy. It's a terrible system, but I don't like any of the alternatives.
Yeah, well, this is why there's so much money in index funds these days, because they feel you can't beat the averages, so you might as well join them. And you think that's a pretty good idea for a lot of people.
Well, I think it's, especially for saving cost and getting pretty broad diversification, there's nothing wrong with guys that have even as much as half or more in indexing. But it's always important to remember that an index and indexes are also strategies. So as I said, a nice broad-based cap-weighted S&P 500, when you peel away the covers, you see, well, it actually co-varies quite closely to a blue-chip growth momentum stock portfolio. So it is a strategy, and therefore mixing in, for instance, those types of managers that may be deep value, or those types of managers that have certain concentrated portfolios, that actually leads to a healthier diversification. So mixing in some asset managers, active managers, so long as they're not index huggers, as we call them, actually can give you better diversity, ergo long-term better growth and lower risk.
Now you have a chapter on what you call your randy old great-grandfather. What did you learn from him?
Yes. Well, like so many people, when my great-grandfather made a lot of money he and his brother in the 5 years after the San Francisco earthquake. And, 52, he basically was sitting there, he and his brother saying, my God, we've made more money, each one of us, than we ever thought together we'd make in a lifetime. So, since my kids are not that, they're pretty spoiled, not that deserving, that includes my own grandfather, he goes, I'm going to live off my money. And so he built himself a nice big house for him and all his servants, and then 2 blocks away he built a little bungalow for his mistress, who happened to be his wife's cousin. And so he thought he was set for life, and unfortunately he lived till 92. The average expectancy of someone at 52 was more like dying in the late 60s, and yet, so he thought he had more than enough money, and it turned out he lived a lot longer. And the issue, what this really taught me, because I remember my mother telling me he was pretty miserable the last 5 years of his life. He wasn't broke, but he was really having to budget, and he did not want to do that. And, that's really what drove me to start studying more about statistics and demographics. And it turns out that, quite frankly, you don't care about the average life expectancy of somebody. What you care about is your life expectancy. And the bottom line is if you're, let's say, even 60 years old, and better health than the average person, not heavy, no big diseases, don't smoke, don't drink too much, and particularly, not poor, more in the affluent side, certainly middle class to affluent, guess what? Your life expectancy personally is not the national average. And in fact, you and your spouse together got a pretty high probability that at least one of you is going to blow by 90. So then
you think this is something a lot of people are not really taking into account today? They think they're going to go earlier, and they're going to be running out of dollars before they run out of time, is what you're saying.
Yes, exactly. And so therefore, when you start thinking that way, you start realizing, oh my God, even though I'm 70 or 75, I still need broad exposure to the volatile assets, because that's where the growth comes from. And I got still a lot of years to amortize the ups and downs. Not for all the money, but for, a pretty good portion. And so, therefore, even a person that's 70, 75, still probably needs, depending on a lot of other factors in their life, nothing wrong for them to have anywhere from 35 to 50% of their portfolio in the broad base of the more volatile assets. Because of that reason, they got 15, 20 more years of growth they need.
Even more so today, when the so-called safe alternatives are producing no return, and long-term bonds are 2.5% or something like that. You're getting very little from those. There's not much income to live on when you have money in CDs and bonds today.
Exactly, and there's no one safe asset class. And even an asset class that starts to look good, well, then it'll get priced higher, and then it's not so good. So that's where the broad diversity, and as I said, trickling in slowly each year into each asset class, and then likewise trickling out very slowly in your retirement years is the secret.
Very good. We're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Tim McCarthy. He is the author of a new book called The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. You can find out more at his website, which is timmccarthy.com. We'll be back after this.
Stocks, bonds, investment opportunities, financial news, and talk. We can help. Call us now toll free, 866-472-5790. 866-472-5790. Voice America Business Network. In sales, are you a lion or a vulture? Lions don't wait. They just go for it. Vultures hang around until the lions are finished and just pick up the scraps. How can you set yourself apart as a lion? Join the other aspiring sales lions and listen to Forget Patience, Let's Sell Something with host Ty Maynard. You'll learn the tips and strategies of top sales professionals. You'll gain more clients at a faster rate and at higher margins. If you're a sales professional, business owner, or executive, listen in every Thursday at 8 p.m. Eastern, 5 Pacific on the Voice America Business Channel.
Have you had a chance to check out Voice America's online magazine and blog, Press Pass? If you love our hosts and shows, check out articles that give an even deeper perspective. Plus topics about health and fitness, movie reviews, philosophy, business tips and tactics, spirituality, positive thought, current events, and even more about your favorite host. It's just a click away at vapresspass.com. That's vapresspass.com. VA Press Pass by Voice America. All access, all the time.
From the boardroom to you, Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Tim Mccarthy, the author of a book called The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. Welcome back to the show, Tim.
Thank you.
So you talk a lot about balancing greed versus fear, and these emotions do swing wildly one way or the other. I'd say probably we're more into greed right now than fear, but how is the average investor supposed to be able to combine control of greed versus fear versus the cycles that are going on in the economy and the markets?
Well, I must confess, it took a long time for me to come up with a way to approach this greed versus fear issue. So many advisors that I work with, they'll sit down with a client and look at it strictly in a rational way of what's the most rational way to construct a long-term investment or portfolio, buy and hold, don't move around too much and the like, good diversification, don't make bets. And then the customer says, yes, I understand it, and then does something entirely different.
Yeah.
And it happens so often that, I remember starting to work with advisors who were offering a voice of what the hell do we do about it? And so I came up with an approach of, rather than fight them, in effect, allow the customers to do at least a little bit of what they want. It reminded me of during Prohibition when they outlawed alcohol. Well, people ended up still making it in their bathtub and everything else. And finally, they realized that, look, we're going to have to allow people to drink, of course. The question isn't whether or not you should be allowed to drink, but how much. And so that's when we came up with this approach called three pockets, which is the first pocket being, of course, your savings pocket. That's the don't lose the pocket. That's the where the fear part comes in. And you want to make sure you got a portion of your money set aside that you just is highly liquid and you can't lose. The problem is, as we discussed earlier in the show, is you don't get any return.
Right, and that's the prospect going forward. You're not going to get any return either going forward.
Yeah, exactly. So then people then, if the greed part sets in, they go to trading, and they think that the only way they can make money is to trade, make bets on either a stock or a market, and timing when to be in and out. But a combination of focused in one area or another versus timing. Well, we all know how much risk that introduces, and also the reality is on average you lose. So therefore, that's where we came up with the middle pocket called the investing pocket, and that's where you put together broad-based portfolio, only investing a little bit each year, building it up, not moving it around too much, and then likewise, very importantly, after retiring, keeping it stable and only taking out a little bit each year. But we left the trading pocket there, that third pocket, and the reason being that every once in a while people just get greedy or hubris sets in. Or even their wife will say to them, okay, look, you can have some money to do your thing because I think you're a good money manager, but we don't want you to be our only money manager.
This is the mad money kind of concept,
yeah, exactly.
Right?
And it's interesting in that trading pocket serves two functions. One, for the guy that is much more into the greed part, this gives them some money to play with, because even if an advisor says, on average you don't make money there, he's still going to do it, so let him. Just make sure he doesn't put too much there. Depends a lot on the personal profile. It may be 10%, it may be 20%, but just don't get too much into that pocket, because you don't want any money in that pocket that you can't afford to lose. But interestingly, over the years and working, it's fun for me because I've been working with investors in, oh God, I don't know how many different countries, and there's often a similar kind of issue where if there's a person that's really afraid about markets, it's actually good to build up a little money in their trading pocket, even if they don't lose it, Because when they panic, you can say, okay, sell out all your trading pocket and just put it into the savings pocket. So it becomes, in effect, a release valve for your emotions.
Yeah, indeed. Now, you talk about diversification globally. This is a key part of the book. How, with the market so volatile around the world and moving so fast, I mean, you have an election and India takes off, or you have North Korea shooting off missiles and South Korea plunges. I mean, there's things happening. Right now we have this invasion of Iraq that's catching the oil markets by surprise. It just seems like one thing after another is always happening globally. How is the average person supposed to stay on top of this and make money without going crazy?
Well, there's a couple of things to look at. One, again, which is the developed world is aging rapidly and actually, on average, has too much debt. So by doing nothing in the more higher growth world, what you're doing is actually concentrating your risk. We don't know, because we've never had this situation, what it's like when the whole population is old. And we're looking at the U.S. almost 40 years of age, places like Italy 44, 45, Japan 47. What it looks like is this is a big depressor of economies. And so that's when you start to go, uh-oh, especially if you look at the amount of debt in a lot of these countries, including the U.S. So then you say, okay, it is too risky to stay just in developed countries. And then you look at the volatility in developed countries. Well, they may not move as fast up and down as a lot of the developing world, but it's been a pretty rocky last decade just looking in the U.S. So when you look at the fact that all markets have volatility, and you don't want to be overly concentrated in one type of markets, i.e. the old economies, that's when you start to look differently at the emerging markets. Now, the good news in the emerging market, this is very different than 10 years ago, is there's about 20, 25 countries that actually really have already emerged. And they're often in a high growth or moderate growth stage. They have infrastructure. And by infrastructure, I don't mean just roads. I mean that they have an intellectual capital now of millions of people that have been trained overseas and come back home, and they bring their expertise home, and they bring a more commercial mindset. Philippines is now a good example of that, but there are many other examples of that, including China. And so, therefore, you've got countries now that look, they're no longer, the poor, unwashed, who knows what's going to happen. They're actually pretty strong. A lot of them have positive reserves, half the debt to GDP of the U.S.,
and a younger population, you're saying, as well.
And a much younger population. And so that's when you start to say, look, they're going to be up and down all the time, but if I'm looking at my portfolio and where am I going to be over the next 2 or 3 decades, that's where the volatility starts to smooth out, especially if I only put a little bit in each year.
So is the way to do that to do ETFs for individual countries or broad-based emerging market funds, or how would you play that trend?
Well, I think going back to this principle of making sure you get the diversification thing right, it's good to have a group of broad-based indices, but likewise, it's important to note that a lot of these indices can be inadvertent tilts and concentrations that you don't expect. I'll give you an example. The FTSE All World Index, you think, oh, God, it's got all the countries in there. And yet, when you look closer, you see, well, a third of the company's global revenues, more, about 37%, come out of emerging markets, yet that fund only represents emerging markets about 10%. So that tells you, well, oh boy, I can't do it just in indexing. So even if indexes are half, the other half can be actively managed funds that are regional funds that are selecting what countries are best to go in and out of. And so getting a mixture of 3 or 4 of the better quality fund companies have a lot of in-country presence, even though they'll cost you a little more, what you are getting is further refinement in your diversification.
So you want some actively managed funds as well as index funds for the international.
Exactly, because it just gives you better exposure to the countries that look more solid and have better growth prospects.
So what would be some examples of actively managed funds or fund companies, and what are some of those 20 countries that you think are looking particularly good long-term now?
Well, again, any one country could get into trouble, but the beauty is if you put a basket together of these countries, and a lot of the active managers do just that, in that basket, we do know the basket of the 20 growth countries, as I call them, one or two are going to inevitably get into trouble. But there's going to be the majority of them that grow probably at about 50 to 100% or more a year than the U.S., Europe, and Japan. And so they include countries, not just BRICS. Everybody knows BRICS. And at different times they fall in and out of favor. I would not necessarily leave Russia in that category, so BICS may be a better acronym than BRICS, just because of where Russia is. It's a good speculative country, but it's not a good long-term investing country. But you'd have to add into it countries like, surprisingly, Mexico. The infrastructure there, the opportunities for growth there are just really long-term prospects are just outstanding, especially given now the talent that's moved back there. The Philippines, the same kind of phenomenon. Poland, of all places, they'll be growing at least 50% more per year than we are. So you come up with a group of about 15 countries that fit into that category.
My guest this hour is Tim Mccarthy. He's the author of a new book called The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. Welcome back to the show, Tim.
Yes, thank you.
We were just talking about some of the kind of growth countries that you think are good places to put it. We went into the BRICS, I guess I'd say, taking out Russia. But what would be some of the other countries you think would be worth investing in for the long term?
Well, again, we're looking at countries where we're seeing politically there is a mindset that's actually been creeped into even the government side that is a commercial mindset, where there's a recognition that that they have to allow a certain amount of free enterprise to grow and the like, and that making sure to take care of the middle class and growing the middle class is very important. And you see this in surprising countries. I mean, take Colombia and Peru. Now, most people, and then Mexico, those three. A lot of people, when they think of those countries, they think of Crocker to Miami Vice and drug deals being done on runways or people running across the borders and the like. They don't realize how far those countries have come. That, to take Peru, for instance, it's got less than half the debt of the U.S. And Colombia and Peru, what they're exporting and cut flowers, they've got very favorable, export, imports, and the likes, and infrastructure. Mexico, we have been, in effect, educating Mexican executives and workers for decades now, and a percentage of them have moved back and are running some very viable companies. So those countries are examples of, you wouldn't want to put all of your money into one of them or even one region, but spreading it out over about 20, 25 countries can make a lot of sense. You may stay away from the more volatile ones, like a Venezuela, of course, or even Argentina now. But the three countries I mentioned before, as well as a little piece in Brazil, that can make a lot of sense over time. In Europe, I mean, most people aren't even thinking of Poland. Poland will probably grow at 50 to 100% a year, faster than the U.S. and the rest of Western Europe for some time there. An awful lot of, in effect, intellectual infrastructure has moved back. That would be a great example of a place to invest. India is, in fact, I've covered recently in some articles, has a very commercially oriented government now. But also, Philippines has had so much, in effect, immigration back into the country that have brought a commercial mindset, brought money, that looks like, a great place if you had a 0.5% of your money or 1% of your money to invest slowly over the next 10 years and then slowly over the following 20 years take out a little bit each year. So those are examples of that basket, what that basket looks like. And it looks so much better than it did 10 and 20 years ago when these countries were so much more undeveloped and did not have any infrastructure.
You would say basically that you should not worry about currency in the short term because it can be volatile, but you're saying in the long run it's the growth of the countries that's most important.
Exactly. I remember one of the very senior members of Fidelity saying, the more I look at currencies, the more in the long run it's all net. When you pay for hedging, that costs you. Whereas if you look over your lifetime, it just, at the end of the day, it just doesn't matter so long as you have a nice, broad, diversified basket of currencies and basket of countries.
Now, you have a whole section in your book on picking a financial advisor, and since you were involved both at Fidelity and Schwab on the advisor side, from the investor side, what are some of the do's and don'ts in picking good financial advisors that are appropriate for them?
Well, it's interesting. I spent so much of my career building internet trading and making it easier for the direct investor and the like. And yet still today, when you look at the assets, that more than half of everyone's financial assets is where they've actually involved or hired an investment advisor. So obviously, it's never been cheaper and easier to buy things direct, but yet when it gets to serious money, once it gets over $200,000, $300,000, that's when people start to say, I better need some help, at least with half my money. And so when you see that tells you, well, then people need help on how to pick an advisor. And yet when you look and see, well, how do I do that, the information is either very sparse or it's written by an advisor, and in the end of the book it typically says, choose me. I'm your solution. So what I wanted to do is put together a nice objective view, unbiased, where because I'm not an advisor, and help people how do they go through the process of picking an advisor. What are the kinds of questions you ask them, and then very importantly, what do you do with the answers? It reminds me when you learn a foreign language and you memorize, okay, where is the train station, and then the guy rattles off the answer, and you go, I knew how to ask the question, but I don't know what to do with the answer. Well, It's the same thing for investors. They'll ask the advisor the question, and then they don't know how to interpret the answer. So, I spend a lot of time in helping them. Is a big determinant the amount of money you have? Is the kind of the advisor you should get? The reality is that less than now today, $300,000-$400,000, and it really starts there and gets better at over $500,000. It's hard to get really high quality advisors. They're there, but it is hard because the economics aren't going to be there, and you can't get the fee only people, for instance. To often look at it. But the good news is that there is a whole group now in the industry of firms like a Schwab, like a Fidelity, that do a pretty good job of when you call up and say, I've got this amount of money, help me through what my portfolio should look at. So you can get pretty good advice from the Schwabs and Fidelities and several other names. And you can do it on the phone. I mean, they've got good call centers to put together a portfolio to invest $50,000 over time. They won't tell you what to do, but that's okay because a lot of people in this day and age don't want to be told what to do. But they'll help validate what you're thinking, or help you in what I would call guided discovery. And you just want to make sure that there's a lot of choices in the individual funds and the like. But the way a lot of those firms now pay is they're not paying the guy on a commission. That you care a lot about that. And so for the average guy that may only have $50,000 to invest, or $10,000 now, and every year he can put away $10,000, they can be a good alternative to getting decent help. What do you think about hourly advisors? Because those exist for a specific area, just to do it by the hour. Well, I think where they're especially good is in the financial planning portion. Now, you think about it, you first have to look and say, okay, how much money do I have, and how much am I going to need realistically, and how do I budget and get there? And that's where the hourly guys are great. They're really trained, certified financial planners and the like. I think when it gets to the portfolio part, first off, you want to know how they're being paid. So if they're just being paid for the hour, that's fine. But if they're also getting paid by different product manufacturers, well, that's got to be a warning signal, because how do you know that the recommendation you're getting is indeed good for you and cost favorable to you? You end your book with what you call the naked advisor, and selecting the right advisor. What do you mean by the naked advisor, and how should one invest to avoid that? Well, just like what we talked about in the beginning of the analogy with food, when I read The Naked Chef and watched his show, I thought, my God, that's very similar to our business. The whole concept he had of get really good raw ingredients, good basic foods, and that you'll be a much better, much healthier and the like. Let the food speak for themselves. And then I realized, well, it's the same in investing. If you've got the underlying instruments, and it's how you put them together, stocks, bonds, and the like, REITs, and the like. So then you can say, okay, now, how do they get constructed? And once you see there's an awful lot of secret sauce and pixie dust and layers of this person taking this fee and then this person taking that fee and all that, when it starts to get complicated, you don't understand it, that's when you start to worry. And it's just like, a very complicated sauce can hide some pretty bad meat. A very complicated investment, multi-layered fund-to-fund structure can also be hiding an awful lot of fees and maybe even more risk than you realize.
At the end, you talk about the lessons you've learned about selecting the right advisor. Why don't you give us some of those lessons?
Okay. Well, I think first, just to conclude over there, if you don't understand what the guy's saying, that's not going to work for you.
Well, many times they don't really explain it in a way that people can understand.
Yeah,
people don't want to
admit find another guy who can get it down into nice, simple, as I said, naked advisor things.
Yeah.
Well, I think at the end, the lessons are pretty clear, and it's a good way to sort of sum up what we talked about, which is really make sure you spend a lot of time in that diversification process, in styles and geography and types of industries and the like. Put a little more time in than you think about it. It's so interesting where people think, I got to pick the best fund. Well, it turns out that's pretty hard to do. Morningstar's made progress, but they're the first to admit that the pure quantitative method doesn't do a good job. Last quarter's top performer is often this quarter's bottom performer. And it often turns out that the difference between, getting an average poor performer versus an average better performer is often not that many, 50 basis points or so often. Whereas getting that diversification right can often be worth 2 and 3 and 4% a year. And so that's really the first stage in terms of asset classes. The second is understanding what I've said before, which is more than ever this century, you really got to diversify your countries. Mm-hmm. And the good news is there's a lot more countries that are a lot healthier. And I think one of the things to say here is when people are looking and saying, oh, God, I visited that country, it was dirty, and then one guy wanted to pay off. You have to remember, don't compare that country today to the U.S. today. Remember what the U.S. looked like at the early part of the 20th century. We look very similar. And yet, that's when we had the big growth. And so that's the attitude you want to take. Don't let your emotions get in the way of good, sound, broad country diversifications.
And you also say that people should not be enamored of a famous expert that can get in your way of making solid decisions.
Boy, that's a great one. I really agree with that one. And then the other point I talked about is diversifying time, understanding that power of time. If somebody says it's time to get in, is it time to get out? Actually, what it is it's always time if you're working to be putting a little bit every year and not worrying about timing, building it up over decades, and then likewise only taking out a little bit every year. Those people that in 1930, the worst crash of ever, didn't panic, just took out that year what they needed to live on or invested just a little bit that they had planned, those are the ones that made out. So understand the power and the magic of time and stretching it out like that, particularly with trickle investing.
Well, thanks so much. My guest this hour has been Tim McCarthy. His new book is called The Safe Investor, How to Make Your Money Grow in a Volatile Global Economy. You can find out more about this at his website, timmccarthy.com. Thanks so much for being a guest on the Money Answer Show, Tim.
Thank you.
And we'll be back with another edition of the Money Answer Show next week. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time, right here on Voice America Business. See you next week.
Thanks again for listening to the preceding program, brought to you on the Voice America Business Channel. For more information about our network and to check out additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the preceding program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and management.